All right, well, welcome back to 5 Homes to Freedom, module number 3. I know that module number 2 was a pretty long one. There were some long videos in there as well. I do apologize for that. However, there was lots of information and content to cover, especially when it came to the analyzers and going through those analyzers. So in module number 3, what we're going to be covering is, I'll get my mouse to work here. There we go. So what we're going to be covering in module number 3, lesson 1, we're going to be talking about accelerating the principal paydown. And number 2, we're then going to look at the effective timing of the payments and how that affects your principal paydown more quickly. Lesson number 3, we'll talk about generating some extra cash so that you can achieve the faster paydown. And then in lessons 4, 5, and 6, we're going to be looking at how to generate some big chunks of cash. In lesson number 4, we'll talk about wholesaling and assignments. Then in lesson 5, we'll talk about the flips. That's your buy, fix, and sells. Lesson number 6, we'll talk about rent-to-owns and or lease options, one and the same. So we'll talk about those 3 different strategies to help generate large chunks of cash. If it's of interest for you, then you can dig in a little bit deeper to find out some more information as to how to actually do them, but we'll talk at a high level about those as well. So let's move forward with lesson number 1. And in lesson number 1 today, what we're going to talk about is what is the actual principal paydown. A lot of people don't really understand what the concept is or what we're talking about when we say principal with respect to the mortgage payment. So we'll dig into that a little bit deeper. Then we'll talk about the different options for paying down the principal, and we'll wrap things up with showing the effect of accelerating the principal pay down as well. So with respect to the definition, what is principal pay down? And quite simply, it's the portion of your mortgage payment that you're making each and every month that is applied directly towards reducing the debt owed. A portion of your mortgage payment goes towards debt reduction, and the other portion goes towards the payment of the interest, the cost of borrowing that money. So the amount applied towards the debt is controlled, though, by interest rate, the interest rate that you're paying, as well as the length or the lifespan of the mortgage. So no 2 mortgages are exactly the same unless you've got the exact same terms and conditions within it. If you have a mortgage at 2.5% versus a mortgage at 3%, then the amount of debt reduction for each is going to be different. They could have the same principal amount. If you borrow $300,000 at 2.5% and another mortgage for $300,000 at 3%, the amount of interest you are paying each month is going to be different between those 2 mortgages. Therefore, the amount of principal reduction is going to be different. Also, the principal reduction changes every month because month 2, you've already reduced the principal amount by a small amount. Therefore, the mortgage interest is going to be calculated based on the balance owing. So it's always adjusting every month. So we're going to look at the effect over the course of a year. So we're going to look at an example. We're going to use a mortgage amount of $300,000 with an interest rate of 2.5%. The amortization is 25 years. And again, amortization is referring to the length of the life cycle of that particular mortgage. It could be 20 years, it could be 30 years. It's whatever you manage to negotiate with the lender. Sometimes the lender will dictate what it is. Sometimes you can ask for a longer or shortage amortization period. In this particular case, the monthly payment would be $1,343.90 each and every month. Now, as I said, a portion of that goes towards paying the interest, the cost of borrowing the money, and a portion of it goes to reducing the debt. That's called P&I, principal and interest. So here's a snapshot of a mortgage calculator that I use. I use this mortgage calculator on a regular basis. You can see the link in the top left corner there if you would like to download this yourself. It's a great mortgage calculator to have on your computer. The reason why I didn't include it in the program itself is because it only deals with one mortgage. It's a great way to look at one mortgage and the effects of different, if you're changing the interest rate, if you're changing the amortization, you're changing the amount of payments, it's a great tool to look at for one mortgage. The challenge is if you have multiple mortgages, it's difficult to track multiple mortgages, which is why I generated the other mortgage calculator, which I've included for you. So this is just a snapshot of what the actual mortgage looks like. You can see here the mortgage amount is $300,000. The interest rate is 2.5%. It's compounded semi-annually. Now, if this, you can use this for American mortgages as well, and you'll see over here in the description that for a U.S. mortgage, calculations can be done simply by changing the compound period to monthly. So you would go into this box here and you would change that from semi-annually to monthly, and you'll see the effect of what the difference is between the two different ways we calculate our mortgage interest. So for Canadians, it's semi-annually, and then for the Americans, it's going to be monthly. So the amortization period is 25 years, and I've put in a 1-year term, meaning that we're fixed at this interest rate for 1 year, just simply so I can see what the calculations are over here. This term can be a 2-year mortgage, a 5-year mortgage. It could be upwards of a 7 to 10-year mortgage in Canada. In the American market, you can get your term equal to the amortization period. So you can have a 25-year term in the U.S., which means you're tied into that interest rate for the full 25 years, which is a really nice benefit to have that we do not have in the Canadian market. You then set the mortgage first payment date and the frequency. We're going to be making monthly payments, so our payment works out to be $1,343.90. At the end of the balance at term, which just means at the balance at the end of 1 year, so 1 year from now we've paid $7,361.76 in interest. We've reduced the debt, the principal amount, by $8,765.04. The outstanding balance is $291,234.96. So that just gives you an example of the mortgage analyzer that I use. So here's the example continued, and I've just transferred those numbers onto the PowerPoint presentation so you can see them a little bit more easily. So again, our total payments over the course of the year, the monthly payment was $1,343.90. We made 12 payments. So over the course of the entire year, we've paid $16,126.80. The interest portion, the amount that we owe to the lender, and that's the cost of borrowing, is $7,361.76. The principal amount is $8,765.04. Therefore, our mortgage balance is going to be the original $300,000 less that principal paid, which is $8,765.04, leaving us with our mortgage balance of $291,234.96. All right, now I want to take this opportunity just to talk a little bit about tax implications, because a lot of people, they believe that because it's an investment property, their mortgage payment is tax deductible. If that was the case, if your mortgage payment was tax deductible, that would mean that you would be able to reduce your taxable income by $16,126.80. Well, that's not the case. So for those who are doing your own personal income taxes, and you're adding in your income from your rental properties, don't get caught in this trap, because the reality is it's only the interest that you pay on that mortgage that is tax deductible. The principal pay down portion of that monthly payment is not tax deductible. So just be aware of that. And that goes for U.S. market or the Canadian market as well. The only difference, a lot of Canadians, they hear that the Americans are able to, for their own personal residence, use their mortgage payment for tax deductions. Well, yes and no. It's not their mortgage payment. Again, it's only the interest portion of their mortgage payment that is tax deductible on their personal residence. In Canada, we do not have that tax saving strategy. However, on both sides of the border, we do have that tax saving strategy for our investment properties. But keep in mind, it's only for the interest portion of your monthly payment, not for the entire mortgage payment itself. Okay, so now what are the options that we have for reducing that principal amount? Well, we can simply increase our monthly payment amount if we can afford to, or we can pay an annual lump sum payment. In most mortgages, the vast majority of them, they do have allowances for people to increase their monthly payment once a year by up to 10 or 15%. They also allow you to put an annual lump sum payment against the mortgage, and they will put a limitation on that. It could be 10, 15, or 20%. They don't mind doing that because they know that the vast majority, like 99.9% of people with mortgages, will not increase their payments or add lump sum payments because people simply aren't good enough with their own personal cash in order to come up with that extra amount of money to pay down their debt. We'll take a look shortly here at what the effects of doing that is. The other way of paying down your principal quickly with options is you're shortening the amortization, meaning instead of having a 25-year amortization life cycle of your mortgage, you can shorten it down to 20 years or 15 years. You can also increase the frequency of the payments. So the norm out in the industry is to have monthly payments. So once a month you make your mortgage payment. That means you make 12 payments over the course of the year. You can also do semi-monthly payments, which is 24 payments a year. So a lot of people get paid semi-monthly. And what they do is they'll just break their monthly payment in two, and they'll make 2 payments. That will shorten the life cycle of the mortgage down, and I'm not sure exactly by how much off the top of my head. We'll see the effect of that in the next lesson, but it's not going to be very much. It's just better for your own personal money management. Where you really start to see an effect on paying down or paying off your principal more quickly by increasing the frequency of your payments is when you get into the bi-weekly or the weekly payments, because you'll see here that with bi-weekly, it's not only are you doing it every second week, but you're actually doing it 26 payments over the course of the year versus 24 payments. So you're actually making more payments, which is why you're going to pay down that principal more quickly. Same thing with the weekly, you're just making more payments. So what I'd like to do now is actually go through a live demo and show you the effect of increasing your monthly payment, the size of your monthly payment, versus applying a single annual lump sum payment. So just bear with me here while I open things up. All right, so you should now be able to see the mortgage calculator. And you can see that we have a $300,000 mortgage at 2.5% interest, calculated semi-annually, 25 years for a term of 1 year. There's our monthly payment, our interest paid, and our principal paid over the course of the year, and our outstanding balance. So what I'm going to do is I'm going to add an extra payment every month. So let's assume that we have $600 a month extra cash flow from our property. If we add that $600 into here, and the payment interval is going to be 12 to make the extra payment at the end of each year. No, we're going to enter 1 to make the extra payment every month. All right, so we're good there. So now you see that our principal paid has gone up to $16,047. So I'm just going to make a note of that. $16,047.69, and our balance now is $283,952.31. All right, so let's go back to what we were before. Take that out of there. So we're back to what it was originally. But now what we're going to do is we're going to make one lump sum payment. So we're going to take that $500 a month, and instead of doing it weekly or monthly, we're going to do a lump sum payment of $6,000. So now you'll see that our principal pay down is only $14,765 compared to $16,000. So it's definitely good, but not as good as being able to make the monthly payment. Our outstanding balance is $285,000, $234. So it's about $1,600 difference. So if you have the option to do the monthly payment versus a lump sum payment, you can see that it's much more beneficial to you to do the monthly payment. So that's the nice thing about having the mortgage calculator, seeing what is the better effect. However, it only works on one mortgage. So what I like about the mortgage analyzer calculator that I created for you is that it's able to look at as many mortgages as you want. I think it's preset for 10 right now. So you can apply that $500 a month on mortgage 1 or mortgage 2 or mortgage 3 and see what the effect is versus the having to do it individually like this. So I'm just going to get rid of that and back to our screen again. Gotta love this technology. All right, so in our next lesson, what we're going to look at is we're going to take a look at that same mortgage analyzer calculator, but we're going to focus on the timing of the payments, whether it be weekly, bi-weekly, bi-monthly, etc. And we'll see what the effects are there as well. So that's the end of lesson number 1. I hope you enjoyed that. And again, should you have any questions, please feel free to contact me. However, I believe that a lot of the questions will be answered over the course of your viewing of the rest of the lessons and or when you attend the live Q&A at the end of this session. So until next time, enjoy, and we'll see you at the top.